This is the reason 90% of US dollars have never been printed, and what that means for the money you think you own. Right now, the total US money supply sits at approximately $22.4 trillion, but only about $2.4 trillion of that exists as physical cash. Roughly 89% of all dollars are electronic entries in computer systems, never printed as paper, never minted as coins, just numbers stored on a screen. Here is what makes this worth paying attention to. Since March 2020, American banks have operated with zero reserve requirements, which means there is no legal minimum they must keep on hand when you deposit your money. Most people have no idea this is how the system actually works. So let's trace how we got here, how money gets created, and what happens when people lose faith in those numbers. For most of American history, money meant something you could hold in your hand. President McKinley signed the Gold Standard Act on March 14, 1900, fixing gold at $20.67 per troy ounce. And that meant if you had $1, it represented actual gold sitting in a vault somewhere. The Great Depression changed everything. Executive Order 6102 landed on April 5, 1933, requiring Americans to surrender their gold coins, bullion, and certificates to the government. Refusing carried a $10,000 fine or 10 years in prison. Less than a year later, the Gold Reserve Act revalued gold to $35 per ounce, a 41% devaluation of the dollar overnight. After World War II, 44 nations gathered at Bretton Woods and established the dollar as the world's reserve currency, with other countries able to exchange their dollars for gold at that fixed rate. This system held for nearly 3 decades. That changed on a Sunday evening. At 9 o'clock on August 15, 1971, President Nixon announced the United States would no longer convert dollars to gold. That moment marked when American money became pure fiat currency, backed by nothing but trust in the United States government. Paul Volcker, who would later become Federal Reserve Chairman, put it this way: if the British, who had founded the system with us, and who had fought so hard to defend their own currency, were going to take gold for their dollars, it was clear the game was indeed over. With the gold anchor gone, the transition to digital money picked up speed. Chemical Bank installed the first American ATM in 1969. The San Francisco Federal Reserve created the first automated clearinghouse in 1972, and credit cards had already laid the groundwork after Diners Club launched in 1950. Here's what the numbers look like today. Cash accounted for 40% of consumer transactions in 2012, but that figure has collapsed to just 14%. An estimated 86% of all US transactions are now cashless, with projections suggesting 94% by 2027. The Bureau of Engraving and Printing still produces 4 to 6 billion notes annually, but that is mainly replacing worn currency rather than expanding the supply. And that raises an obvious question. If physical cash isn't expanding, where does new money come from? Economist John Kenneth Galbraith, who advised President Kennedy, wrote that the process by which banks create money is so simple, the mind is repelled. With something so important, a deeper mystery seems only decent. Here is the simple truth that the Federal Reserve itself acknowledges. When a bank makes a loan, it does not lend out existing deposits. New money gets created by typing numbers into an account. The Federal Reserve Bank of Chicago stated that the actual process of money creation takes place primarily in banks. A Philadelphia Fed working paper from 2023 found that 92% of deposits in the banking system result from bank lending activities, with only 8% coming from actual cash deposits. There used to be limits on this process. Banks with large deposits had to keep 10% in reserve before March 2020, but the Federal Reserve reduced reserve requirements to 0% on March 26, 2020. That marked the first time in history that banks had no legal obligation to hold any portion of customer deposits. The St. Louis Federal Reserve acknowledged in 2021 that the money multiplier has been a standard concept in introductory economics classes for decades. But changes in the way the Fed implements monetary policy has made the model obsolete. The Federal Reserve itself creates money on a massive scale. Before the 2008 financial crisis, the Federal Reserve's balance sheet held about $900 billion. Through quantitative easing programs, that number reached $4.5 trillion by 2014. COVID pushed those numbers into new territory. Between March 2020 and March 2022, the Federal Reserve added approximately $4.6 trillion, which exceeded all previous quantitative easing combined. The balance sheet peaked at nearly $9 trillion in April 2022. Paul Volcker's words carry new weight in this context. The truly unique power of a central bank, after all, is the power to create money, and ultimately, the power to create is the power to destroy. If money is just numbers backed by trust, what happens when that trust evaporates? Spring 2023 provided the answer. Depositors at Silicon Valley Bank tried to withdraw $42 billion on March 9, 2023, all in a single day. That speed for a bank run was unprecedented, driven by mobile banking apps and social media coordination among tech industry depositors. Regulators seized the bank the next day, making it the second largest bank failure in American history, with $209 billion in assets. Signature Bank collapsed 2 days later, and First Republic Bank followed less than 2 months after that. 3 of the 4 largest bank failures in U.S. history happened within a 2-month window. 88 to 90% of Silicon Valley Bank's deposits exceeded the FDIC's $250,000 insurance limit. The government invoked a systemic risk exception to protect all depositors at an estimated cost of $20 billion to the FDIC's Deposit Insurance Fund, which currently holds about $141 billion while insuring over $10.7 trillion in deposits. The fragility of the current system has not gone unnoticed. Satoshi Nakamoto published the Bitcoin white paper on October 31, 2008, just weeks after Lehman Brothers collapsed. The first block, mined January 3, 2009, contained a pointed message, the ×3. January 2009. Chancellor on brink of second bailout for banks. Somewhere between 21% and 30% of American adults now own cryptocurrency. Former Federal Reserve Chairman Alan Greenspan offered his own perspective in 2011. Gold, unlike all other commodities, is a currency, and the major thrust in the demand for gold is not for jewelry. It is not for anything other than an escape from what is perceived to be a fiat money system. The money in your bank account is a promise, an entry in a ledger, backed not by gold, not by legally required reserves, but by institutional trust and the coordinated belief of millions that those numbers retain value. 90% of dollars exist only as database entries. Banks create money when they lend. The Federal Reserve's balance sheet grew from under $1 trillion to nearly $9 trillion in 15 years. 3 of history's 4 largest bank failures happened within weeks of each other, and $42 billion fled one bank in 24 hours through smartphone apps. Your money is not gold in a vault, and it is not even paper in a drawer. Those are numbers on a screen. and the whole thing works only as long as everyone agrees to believe it does.